Good evening to all of you. But first of all, I'd like to apologize. Today, I'm not at my best. I have a bit of a runny nose and a scratchy throat. So if you don't mind, from time to time, I have to blow my nose and clear my throat. So this is a little bit under the weather for now. Now, the thing is this. I'd like to welcome you guys to another webinar. And this is a series of webinars that I have been doing for CME Group as well. And today is one of those days. And today is a very special day. Now, today is the FOMC. Now, if you have no idea what's the FOMC, it is the Federal Open Market Committee meeting, which the Federal Reserve Board of Governors will gather and decide as to whether what they want to do with interest rates. Are they going to hike? Are they going to pause? Are they going to cut? So today is going to be very interesting. And the result will be out at 2 a.m. our time. Okay, so do watch out for that if you are awake by then. Now, before we get into the content proper itself, let me remind you that this presentation is not an offer to buy or sell any kind of securities, be it futures or options. And do understand the trading of any kind of margin products do carry risk, like what Sherette said. It is margin product, so it does it may not necessarily be suitable for all. And just make sure that you understand what you're getting into before you attempt to trade any kind of margin products. And of course, there will be a big segment in which I'll be giving you my views, and those are my views, and definitely got nothing to do with the host and the sponsor for this event. So we will not be responsible for anything that you may do as a result of attending this presentation. Now, with that out of the way, let's get started. Now, of course, the content here says that Futures 101. Does anybody know what exactly is a futures? Now, for those who are new to this, let me give you an illustration. I used to work in a bank as a foreign exchange dealer, and I will use that as an example. Okay. Now, for example, let's say you are a manufacturer and you have an order from an American firm, and the order is worth 1 million US dollars. Now, when you sign on the dotted line and you're committed yourself to deliver whatever you're selling to the American buyer at 1 million US dollars. Now, of course, there will be a lag time from the time you sign the contract and when you actually make the delivery. And the date, of course, in the delivery will be specified in the contract itself. So from now until your delivery date, the foreign exchange rate may actually move. So exchange rate may move in your favor, may move against you, but that is not what you want. You want to transfer that risk to another party. So you call up your commercial bank that you normally have a relationship with and say, look, this particular date, I will be receiving $1 million and I want to lock in the dollar versus ringgit rate right now. Can you give me a price? So the banker will do his calculation and give you a price. And if you're happy with the rate, because at that rate, you would have made a profit, right? So you agree to do at the rate itself. So come delivery time, what happens is that the customers in the US will pay you the $1 million and the bank will pay you whatever that was agreed in terms of the exchange rate in ringgit. So in that sense, you have already transferred that risk to the bank. What the bank does with that position is not your business anymore and is not your concern. So this is an example of a forward contract. Now, a futures contract works very similarly to a forward contract, but the issue here is that you don't get to define what is the contract value. Okay, in terms of the contract size, a futures contract is something similar to a forward contract, but it's traded at a centralized exchange, whereby the contract itself is all specified in terms of contract size, the tick value, and the expiration date, the delivery date. All this has been specified. The only thing that is not specified is the price. So the price, of course, is open to competitive bid and offer. So that gives you an idea what a futures contract is all about. Okay. So any question about that? I hope you can get a good understanding of what a futures contract is. It has been around for hundreds of years, so it's nothing new. Okay, so this is actually something that you can trade if you got a view of whatever market that you are tracking. Now, there is this quote that I love to share. Markets are very efficient in transferring wealth, right? From those who do not know what they are doing to those who know. So make sure that you understand what you are getting into. Do your homework, do your own diligence, and of course, have some education before you embark on this journey, because education is absolutely necessary before you come into this space. Because like I said earlier on, margin trading can be risky, but it can be also very rewarding if you know what you are doing. Okay, now, when we talk about the Futures 101, I like to share with you my various experience. I started in this business back in 1985 as a commodity broker. Now, I have no idea what a commodity is. no less what a futures contract is back in 1985. I was only 25 years old. So basically, I stumbled into this business, and shortly thereafter, so have it that, 2 years, less than 2 years after I entered this business, I actually witnessed one of the most defining moments in my life. In 1987, the stock market crashed. That crash was so severe that at that time, newspapers were comparing that to the 1929 global deep depression. Of course, we were not born then, but the deep depression was obviously a very traumatic time in US history. In those days, markets are not globalized, so it's basically contained within the boundaries of the United States. But the Great Depression came after the 1929 stock market crash. So the 1987 crash was compared in the same breath as a 1929 stock market crash. And I had a good fortune of trading the Hang Seng Index future, and that was something that actually changed my life forever. Okay, in the beginning, I just take my job as just another job, but I realized it is life changing. I decided that this is going to be something I want to do. I have never started off trading equity, so I have no preconceived ideas. I am able to sell if I got a bearish view. I am bullish, I can buy. So basically, I am not confined to buy only kind of strategy, which most equity traders or investors are accustomed to. Okay, so basically, I actually started off with the idea that I can I can do both sides of the markets. If a market is bullish, I can buy. The market is bearish, I can sell. Okay, there's something about selling forward is something very alien, and it's not necessarily looked upon very kindly in equity tradings. There's a thing called the short selling. Short selling, some exchanges do not allow it. Some exchanges outright ban the practice of short selling, something that you do not have. You borrow the script and then you sell forward, and hopefully the market go down. You can buy back at a better price and return back the script to whoever you borrow it from. So those are the things you can do in equity trading, but futures trading, you can do both sides easily without any restriction. So that was then October 1987. It was coined a Black Monday. And it was really black because I was at that time 27 years old. I was stationed in Auckland, New Zealand. I was trading the local products, and because the market is so illiquid, I decided to trade at that time the Hang Seng Index, which was actually very tradable, and I happened to be selling 2 contracts at the morning itself before the market went limit down, and shortly thereafter the market suspend operation for 5 business days with the idea that if they close the exchange, the panic would not spread. But it had the exact opposite impact. The markets panic, and all around the world, we can see from Asia to Europe to back to the States, every day when the market opened for the 5 days in which the Hong Kong Future Exchange was closed, the market went limit now for 5 days. And I am very proud that I'm one of the very few that caught the entire move down, and it's all over in just 1 week. Okay, and you can see the power of a bear market. So I realized the market is can be very profitable in a bear market, provided you know what you are doing. Again, so the reason thereafter was drilled down to a few possible reasons why the market crashed the way they did. One was a fear that stocks was severely overvalued. 2, persistent US trade and budget deficit. And 3, rising interest rates. Does this sound familiar to you? I hope it does, because another explanation came from the decline in the dollar. So again, is it very familiar to you? So again, we have the same condition as what happened back in 1987. So I'm very excited. Okay, so the crash was also accelerated. By then, we are beginning to see computer-driven models for trading, and that was actually attributed to machine-driven sell orders, and they actually tried to ban algo trading then. Okay, so anyway, the exchange, the CME, actually launched the first global equity index futures in the S&P 500 back in 1982. It was very opportune. Of course, at that time, I wasn't trading the S&P 500. I was trading something in Asia, and you know what happened then, okay? So that was the day. You can see this market actually went down from 2,746. Now, this one will appear very unfamiliar because the pricing is so unfamiliar. Right now, we are in 35,000. Yet back then in 1987, the market was trading below 3,000 points. Okay, so the market was actually coming off very sharply, and then there was a gap down. That was what we call the Black Monday. Okay, the market dropped 800 points, and the New York Times was screaming a Great Depression is coming. So the market actually happened all very, very fast, and the market hit the bottom at 1,616.2, and it all happened just within 1 week, and it's all over. Okay, and now, when we look back at the Dow Jones itself, currently we are the high traded so far at the beginning of last year was just under 37,000. You can see this number and this number where it happened, $1,616, 1,616. You can see that the market has actually gone up by 38 times. Okay, this is a bit scary. So the entire bull market here is still very much intact. Okay, so you can see the market at that point in time was considered to be very severe, so severe that they are comparing it to the Great Depression. But on hindsight, now when we look back, it was only a little blip. So we can see the market has been becoming more and more volatile. The dip has been a lot more severe compared to them back in 1987, and the rise has been phenomenal. Since the pandemic low, the market has doubled in value. So you can see that the market has become the breadth and the depth is actually very enhanced now. So definitely it is very, very tradable. Okay, from a trader's point of view, that is very exciting development here. Now, another event that changed my life was in 1990. I was a gold dealer back in 1989, and that was the first time I saw when the screen went blank. Okay, meaning to say that there's no bid offer on my screen. In those days, we are still using monochrome screen. Okay, we don't have news wire that flash news across my screen instantly. We are still using Telerate. Telerate was a service provider that provide pricing. Okay, from all different sources. So at that time, Iraq actually invaded Kuwait back in 1990, and that caused the market to explode because we do not know what caused the market to jump $10 per ounce. Because in those days, gold was traded around $300 odd, and the bid and offer spread is about 30 cents. So suddenly we see a $10 spread. We didn't know what hit us, and it was only much, much later that we realized something big has happened, and that was also known to be the first Gulf War. Okay. That was traumatic. Okay, and at that time in the futures contract, I wasn't trading the COMEX then. I was trading the spot market, and you can see that on that day itself, during the period, the market jumped $45, and that is a representation about more than 12% in a very, very short space of time. The market reacted to the upside, and you can see gold prices went from about $380 all the way to $425 in just a blink of a couple of weeks. Okay, so you can see that represents a big move here. If you have bought a futures contract then in COMEX, that would have yielded $4,500 per lot. Okay, and of course, if you're on the wrong side, this is how much you will stand to lose. Okay, so if you are trading the micro, of course, we don't have micro then, but if you are trading micro, if we have this kind of move, that is very lucrative. You can see it's about $458 per micro lot. So this will give you an idea when a market moves based on a fundamental, it can be very, very stressful, okay, in the sense that market breadth and what width is actually quite wide. Then another event, 1991. That was when Operation Desert Storm actually started during the President Bush Senior. He actually started a bombing campaign, and which eventually liberated Kuwait. So that movement itself, that day itself, hardly. The surprising part is that markets hardly even moved, okay, during this period where this war was actually executed. Then if you can see that the market actually in the crude oil itself, I'm talking about equity market did not move, but crude oil market actually moved. Crude oil market actually fell from $32.75 to $17.45 in just 3 to 4 weeks, and it's all over. Okay, and that amount to something like $15,300 if you are short one contract of the crude oil, the regular crude oil contract itself. So you can see how lucrative it can be. Okay. Now, another example will be the 2020. We fast forward it 30 years to 2020. And of course, we know what happened 3 years ago. We have COVID-19 on March the 11th. the WHO declared COVID-19 as a pandemic. And we can see that initially the market did not really move that much, but after the lockdown happens and the market started to move violently, okay, we can see that the market actually crashed. That is the infamous drop in crude oil prices from around $36.35. It dropped to negative $40. And that was something that I've never seen again and seen before and will probably never see again, because it is almost ridiculous to even imagine crude oil prices can go negative. Okay, a lot of people were looking at the screen and thought, if it's come close to zero, I think I want to go in and buy, because in our mind, something as important as crude oil should have some kind of value. It cannot go below zero. That was the mistake a lot of people did, because their screen did not update. For a lot of retail investors, they didn't see the market went very swiftly into negative territory. And a lot of people bought near the zero line and they realized that they have suffered massive losses. But if you have gone short, one contract of the crude oil, is going to be worth a lot of money. It's $76,670 per contract. So you can see how volatile the market is if there is going to be a driver behind that move. Okay, and right now we are definitely in unusual times. Okay, a lot of things can basically happen in a blink of an eye. Okay, we have an ongoing war in Ukraine. Something bad could actually happen, and it can escalate. And what else can move? Everything will move. Equity market will move. Commodity markets will move, currency market will move, precious metal will move, everything will move. So if you have a view, you can imagine how lucrative that can be. Okay. Now, this is more recent. February of 2022, what happened on that day? We have Russia moving into Ukraine, in what is called a special military operation, in which President Putin is trying to liberate Donbass area, okay, because the area has a lot of ethnic Russians staying there, even though after they have separated and they are basically Ukrainian living, they are Russian living in Ukrainian land, okay, basically that was the day, and the market actually moved. What moved? Wheat. Of all the things that moved was wheat. Now, if you understand that both the Ukraine and the Russian, especially Ukraine, is actually the breadbasket of Europe, because Ukraine has very fertile black sand, black soil, and they produce a lot of agricultural products, including grains. And of the grains, wheat is the major one. And you can see on the day itself, the market actually went higher from $849 per bushel all the way to $1,364.50 per bushel. You can see the market went up by 60% in just 2 weeks, and it's all over. Okay, and that would have net you $25,700 if you hold on to a long wheat contract. So right now we are still having that aftermath. Okay, so more recently, this week what happened? This week, Russia has actually refused to renew the Black Sea Grain Initiative, in which they allow Ukrainian grains to be shipped out of the port of the Black Sea port, so that the grains can actually reach the rest of the world. But what Russia says is that most of the grain did not reach the African nation, where it was told that it's meant to be to feed the Africans and all these underdeveloped countries. The bulk of the grains actually went to Europe, and especially after Ukraine admitted that they have struck the Crimea Bridge twice, not once but twice, and in retaliation, Russia decided not to renew the grain initiative, and that caused the market to spike almost immediately. And this is what happened. Okay, from around $642 per bushel, market went up to $777 in just a few short days. You can see that the market has gone up by $700 odd. You can see the market is huge. Okay, in this case, if you hold on a lot of a wheat position, you would have net $36,700 odd. So this is where we are right now. Market can be volatile because there are so many things happening on the economic front. We are possibly staring at a global recession, what implication it may have, what will interest rates do, especially tonight during the FOMC, what will the Fed chairman says about going forward for the balance of the year. Because last month, although the Fed actually held interest rates unchanged, and he actually telepathed to us that for the rest of the year, we're going to see at least 2 more rate hikes of 25 basis points each. And tonight is one of those days. If we include that as well, that means for the rest of the year, we are looking at no more than 1 more rate hike, and the market has already priced that in, and equity markets are getting ready to rally. Now, what can cause this thing to unravel is that Powell himself gives himself some wiggle room in the language that he used. If tonight the Fed chairman says that he's going to be watching the data and the decision whether to hike or not to hike more than 1 more rate hike is dependent on data. This one language is going to cause the market to panic, to assume that he is giving himself a bit of a wiggle room in case the data come in hot and inflation is rolling back again. He can have the option to start hiking rates again. So do watch out for the language tonight. It's going to be crucial. I think market is going to be volatile. It has not been volatile for the last 48 hours, but that would all change at 2 a.m. Tonight. Okay, so do watch out for those developments. Now, this is exactly what I said. Now, in the event, okay, what will happen if the Fed chairman said what I just mentioned? If he gives himself a little bit of wiggle room, the market is likely to cause movements across all asset classes. In treasuries, we can see the yield is likely to rise. Okay, in equity market, very likely it will see profit taking. Okay, after all, the market has been going up for what? For 9 months in a row right now. So we can see that equity prices are very, very rich, although right now we are in the middle of the earnings season. And if the Fed chairman actually said that he's going to watch data to decide whether or not to hike further, then of course this may actually happen. And the dollar may actually rally. Any kind of interest rate hike into the future is definitely going to be bullish for dollar, for example, and as a result, commodity prices, including gold and crude oil, may actually fall back. So these are the consequences if that is the language he chooses to use. I'm not saying that he will, but I say if he does say something along that line, then this may actually happen tonight in the right after his Q&A session. Now, interest rates. If you got a view on interest rates, you can trade either the bond directly, okay, or you can trade the yield. So if you got a view of where interest rate is likely to head, then obviously you can actually pick a product in which to trade that view of yours. Okay, now here we have the 2 years Treasury note. Now you have to understand that the US Treasury issue a wide range of treasuries, or all these are debt instruments from the short end of the yield curve, from anything below 1 year, those are called the treasury bills. Anything between 2 to, let's say, 2 to 10 years, those are the medium term note. Okay, then of course we have the long term bonds, those anything above 20 to 30 years bond. So you can see that if you're trading the lower end of the curve, you could be trading something very, very popular. That is called a 2-year treasury note, and this is a summation of the contract spec itself. You can see that the face value is about 200,000, and the symbol is very important because there are so many issues on different treasuries, so you must get the symbol correct. You pick the wrong symbol, you could be looking at totally something else. Okay, so you can see that this has been summarized for you, and I actually make your job easier. I convert all the central time to Malaysian time, so you can see it starts at 6 o'clock on Monday morning, and it doesn't close until Saturday morning at 5 a.m. our time. Okay, and do note that this one is deliverable, meaning to say if you hold a long position all the way into the last trading day, you are expected to take delivery. Likewise, if you're holding a short position, you are expected to deliver. Of course, the underlying is the futures contract, not the actual bond itself. It's the futures contract. So the maintenance margin for now is $1,150, and the intraday, if you're not going to hold position overnight, is 245. Now, mind you, this is a very, very liquid market here, and of course, this is trading the regular size. Okay, so you can see that the market has been coming down, and if it does come down a little bit, I am of the view that we could be seeing a buying opportunity somewhere between 101.05 to 101.09. Okay, so this is my view. You don't have to trade those view of mine. So I'm just saying that as a counter trend, it does look lucrative at those levels. And if I have a view, I want to trade those view, I could actually go long on a 2 years treasury note. Now, on the other hand, you can also trade the reverse. The reverse means this is the bond. Earlier on, the 2-year note is the bond itself. You can also trade the yield. Now, the yield is the pricing is actually the reverse. Earlier on, you notice that the price is coming down. Now you can see the yield is going up. So it's actually two sides of the same coin. Okay, so just remember whether you're trading the yield or trading the underlying bond itself. So in this case, the yield has been going up to 5.025, and the market is carrying to a point where I think it makes a lot of sense to go counter trend. For example, if tonight the market go up to 497 to 5025, I want to be looking to sell because that offers me a very low risk, high reward payout setup here. Okay, I'm not saying, again, this is my view, it's not necessarily your view. So this is, if I got a bearish view going forward, I may want to trade this as a counter trend. And you can see that the margin required is actually very affordable. Now, when you can see that this is a micro 2-year yield, which is actually geared towards you and me. Okay, the maintenance margin is $370, and the intraday is only 85. So you can see that it is definitely something that we can do because it's not very taxing financially. Okay, and of course, this one is different from the 2-year note itself. This one is financially settled, so you don't have to worry if you hold under the last trading day, which I don't recommend. But if you happen to be holding a position all the way to the last trading day, either long or short, you don't have to worry about delivery because it's financially settled. Okay, so do watch out for this. Okay, and this is the volume and open interest. Here you can see that on the average day, it's about 500,000 contract traded every day. So it's a very, very liquid for the 2-year note. And the open interest is scary, 3.6 million contract that is not closed out. So you can see that people who trade the 2-year treasury notes, those are either swing traders or long-term traders because they don't liquidate. Okay, you can see that the open interest is way, way above the daily traded volume. You can see even the volume here is very respectable. 500,000 contract will be considered as very liquid. Now you want to choose a product that is very liquid because it will actually mitigate your total risk, because all you want is the market risk. You don't want the other risk, okay, which is the bid offer risk. For example, if you have a long position and you cannot get out because the market is illiquid, then that will be less than ideal. You want to choose a market that is very liquid, in which every time you want to go in and out of the market, you only have to give up the spread, which is very, very, very narrow in a very liquid market. Now, the other one that you can trade, of course, is the 2-year yield futures, and these are the volume and open interest. Of course, they are nowhere to be compared to the regular underlying. We can see that the traded volume is less than 500 lots per day, and the open interest is less than 1,000. So it's less in terms of the volume and the open interest, but it is also something that you can actually take a view and trade if you want to. Okay. Now, the other one I want to share with you is equity index. Now, this is one of the most successful group of product that CMS has ever launched. Ever since they launched the S&P 500 back in 1982, it has remained the most welcome and the most attractive products ever launched by any exchange. And of course, other exchanges has emulate CME in launching an equity index futures, and those products has also seen very, very good response from the retail investor. So there are at least 4 major equity index futures you can trade of the CME product. Okay, so of course we know that just before the pandemic, the CME actually launched something called a micro E-mini equity index futures. It was so timely. Okay, so you can see that this is a 1/10 the size of a regular S&P contract. Now, in those days when I was trading S&P back in the late 1990s, there was no such thing as E-mini or the micro E-mini. So basically, we only trade a regular contract. In those days, we can afford because you can see the notional value is nowhere near 35,000 or this kind of levels. Well, we were basically trading the regular contracts, and the only contracts that was available then was a regular. But these days, the notional value has gone by so much. Like I said earlier on, since the pandemic, the market has actually doubled in value. So obviously, the CME will have to find ways to create new products for the retail investors to make it affordable, so that they lower down the barrier to entry. So we can see that we have seen the S&P 500. This is probably the most liquid contract beside the Nasdaq 100. So you can see the trading volume is huge. And the price has been going higher and higher and higher. We have this year, since Q4 of last year, the market has been rallying non-stop. Led by what? Led by tech stocks. Now, if you remember last year, throughout the whole of last year, tech stock was an unloved child. Nobody wants to have anything with tech stock. So tech stock was heavily sold to the point when by the new year begin in 2023, it looks really cheap in terms of valuation. So the hedge funds have went in big time to scoop up all these seriously sold tech company. And today we have the S&P 500 rallying into new high, and the market is trading at new high only recently. Last Wednesday, we can see the high traded as 4,605 and a half, and this is a high for the year in terms of the micro E-mini S&P 500. You can see this price rise to me is actually getting very, very attractive as a counter trade potential. Okay, the prices is between this bracket of prices at 4,542 and a half to 4,631 even. I like to have a view that market right now looks very attractive to be trading counter trend. I could be wrong, but if I'm wrong, the risk is so small. But if I'm right, the payout could be huge. Okay, so this is my view again. So the margin requirement for this, for maintenance in the whole position, either long or short overnight, is $1,120. Intraday, if you are doing scalping, for example, it's only $37 per contract. So it's dirt cheap, okay? And the point value, of course, is nowhere near the regular. It's $1.25 per quarter point. So you can see this is available. And these are financially settled, meaning to say they don't have to worry about delivering the underlying component stocks at all, okay? So this is the micro E-mini Nasdaq. This has huge volume, so much more than the S&P 500, but they are a class of its own. This between the two of them, the volume trader is so huge that it pays to actually devote some time to understanding these two products. Because if you got a view, okay, especially if you think that anything AI is still worth buying, or anything that is speak in the same language as ChatGPT, which has been the flavor of this year itself, that could be something that if you got a view, if you think it's still cheap, you can always look to engage this market through this product here called the micro E-mini Nasdaq 100. Again, this is a very affordable contract. The maintenance margin for overnight is $1,680. Only because the notional value is a lot higher than what we see in the S&P 500. And the intraday, if you're not holding position overnight, is only $85. Each quarter point is 50 cents. So it again is financially settled, very, very attractive. Again, I'm of the view that it is very attractive to do a counter trend. Okay, so if I'm right, okay, I could possibly see a great payout. If I'm wrong, my risk is actually quite affordable. Okay, now in terms of volume and open interest, you can see that the amount of volume traded here is in excess of 200,000 contract for the micro E-mini S&P. So 500,000 contract traded per day is very respectable. Okay, and open interest in excess of 500,000 contract. Okay, this is not even the average. The average is possibly about 800,000. Okay, so up to yesterday, the open interest was 550,000, so which is very, very liquid. Okay, on the other hand, when we look at the micro E-mini Nasdaq 100, the volume traded here is 123,000. Okay, not as much as the S&P 500, but you look at the open interest here, 828,000 for last night alone. So you can see that most of the people who trade these two products, they tends to be day trader, because I'm so sorry. This open interest. This is the volume. So the volume traded is 800,000 for the Nasdaq 100, and the volume traded for the S&P 500, the micro E-mini S&P 500 is 500,000 contract, and the open interest is actually very low. It means to say most people actually square off the position intraday. So when you see the open interest below the volume, you know that this market is very popular with day trader. Okay. The other product you can trade, of course, will be the Dow. Now, the Dow is the bluest of blue chips, 30 stocks within this composition itself, and most of the time is traded by the money managers, the hedge funds. So they don't go down and trade the S&P 500. Okay, they are mostly concentrated in this particular index itself. So you can see that it is not necessarily an index that will attract the retail. It's more for the money managers. Okay, but because of the introduction of this micro E-mini Dow itself, we are now able to trade the same thing as the hedge fund managers. Okay, we can see that contract size is very, very affordable. You can see for every 0.1 point move is equal to 50 cents, and it's financially settled. and margin requirement is a lot lower than a micro E-mini S&P 500 or even the micro E-mini Nasdaq 100. It's only $800 if you want to hold position overnight, and if you're doing intraday, it's only $60. So again, in the same thing, I do see that this market right now is coming to the bracket of prices that is increasingly very attractive to me to trade counter trend. And if I'm right, at the minimum, from where it is last traded at 35,571, if I'm right, at a minimum, I can see a potential for a drop back to 33,800 points. Okay, so that could represent quite a bit of a movement here for a short-term trade. Short-term to me means a couple of days. Okay. Then of course the other product you can actually trade. Now a lot of people may not be familiar with this index here. This is the Russell 2000. The micro E-mini Russell 2000 is a small cap index. In it, there are 2,000 component stocks, of which most of the company listed here are companies that you and me probably are not very familiar with. Okay, but they have a very high concentration of regional banks. Now remember in March what happened to the regional banks? One shut down after the other. Remember SBB, remember First Republic. You can see that those are the banks that are very exposed in this index here. Let's say, for example, if you believe that the banking crisis is not over and we are likely to see another resurgence of a banking crisis, this could be a good index to actually take advantage of that view itself. Okay, although the market here has not been as high as the other three major equity index, still, I'm of the view if we have a further rally in this index itself, possibly the market will get into a position whereby will have a view. Right now, I will have a better fish to catch in the other three index. Okay, the margin requirement is $620 for overnight and $30 only for overnight for day trades. So you can see that it is very, very affordable. Now, what about the open interest and volume? You can see that the open interest is again reflective of the same thing that we saw in both the micro E-mini Dow and the micro E-mini 100 Nasdaq 100. The volume traded is 500,000, and the open position is less than 300,000 for last night. This is the micro E-mini Dow. Now, micro E-mini Russell, okay, have also about 500,000 contracts traded every single night. Okay, and the open interest is a lot lesser than the micro E-mini Dow, hovering just around 18,000 thereabout. So you can see these two products, very similar to the other two, basically very popular with the day traders and scalpers. So if you have a very short-term view, these products tailor-made to you. Okay. Now, what about commodities? Now, commodities has not been in the headline for a long, long time. Commodity players has been in a very long winter. If those people who trade crypto think that the crypto winter is long, wait till you compare the winter in commodities. Commodity prices has never really been in the news that often, but lately we can see after the war in Ukraine started and as late as this week, when Russia actually do not want to sign on to the grain initiative again, we can see that grain prices actually move big time. Okay, so I want to spend a bit of time to talk about wheat itself. Okay, now one of the most popular commodity product is actually the WTI crude oil. Now, WTI stands for West Texas Intermediate Crude Oil. And this is one of the two benchmark crude oil. The other one, of course, is the North Sea Brent. Of course, the Brent trades at the slight premium over WTI. But WTI is very popular in the state. After all, it's an American product. And the regular contract size is 10 times bigger. This one is only 100 barrels per day, per contract. And the symbol is MCL, and the point value is 1 cent equal to $1, and it's financially settled. You don't have to worry about delivery. The margin requirement for overnight trade is $580 for overnight and $48 for intraday. You can see that I also have a view here. The market has already gone up to my target of around $80 per barrel. And at this current level, I am not keen to buy. In fact, I'm waiting for it to pull back. I am long-term bullish on energy products because I do not for one believe that the war in Ukraine is going to end anytime soon, and anything can actually get out of hand, and that will actually cause price in energy products to escalate. The other thing that I also look at is the fact that the US is currently replenishing their strategic petroleum reserve, and the way and the level in which they are buying. You can see these three bottom here in this chart here. The American government is actually buying around $67 to $72. So anything beyond $72, they are not buying, but if the market slide back to $72 and lower between 72 to $67, they are net buy. You can see the market actually held up very, very well. So if you know where the American government is buying, that have already placed a floor under the market, so there's only upside and no downside, okay, unless something really weird happens, okay. So right now we are basically waiting for the market to pull back to a more sensible level. I will start accumulating position from $74 for your information, okay. I have a very, very bullish view. How bullish can I be? If something really, really bad happened and the war in Ukraine actually escalates, okay, I won't be surprised if crude oil prices goes to $200 per barrel. The height of the Ukraine war was only $130 per barrel. Of course, that is a very long-term view, okay? And that, of course, it's not necessarily based on economics. They are based on geopolitical tension, okay? Now, the other thing that you want to see is also the volume and open interest. You can see that the volume traded is actually very respectable, 75,000 contract on the average. Last night, we had 74,854 contract traded in the crude micro WTI crude oil. Open interest is 15,000 thereabout. You can see that most of the people who trade this are, again, day traders and scalpers, okay? Very popular with the retail. Now, this is something that you may or may not be aware of. There are which contract you can trade. Now, there are two basic groups of which you can trade. One is the SRW, which is the soft rate wheat. The other one, of course, the hard rate wheat. So the one that I'm sharing here today is the SRW, which is the soft rate wheat. Very popular with American farmers. And this one is 1,000 bushels per contract. Okay, they are all measured in bundles, one bushel. Okay, so you can see that the product code is XW. So make sure you get the code correct, because like I said, there are other derivatives of wheat that you can actually trade through the CBOT, which is part of the CIB group of families. We can see that this is a deliverable contract. So be very aware of the last trading day. Okay, don't make it a point whereby you don't trade into the last trading day itself, because this one, it will end up with actual delivery. If you hold a long position, you expect to take delivery of this wheat. Where are you going to store? I have no idea. I'm sure your broker will not be too happy if you go into delivery. Okay. Likewise, if you're holding a short position, you're expected to deliver this particular grain, wheat, to the warehouse designated in a contract itself. So be aware that this is deliverable. Be conscious about this fact here. Now, the maintenance margin for holding a position overnight is $600, and the maintenance for an day trade is only $60. So you can say the market is nowhere near by either the buy or sell range. So it's right now stuck in between. I'm just going to monitor, and if the market continues to go higher, anywhere around $850 per bushel, I think that will be my target for now. And can I buy? I will be buying, that's for sure, because it's too far away from my ideal setup, okay? Now, in terms of volume and open interest, it is not that fantastic. You can see that the volume traded is only about 6,000, and we can see that the last few days has seen renewed interest in this product. You can see on the average, it's trading about 2,000 lots per day. You can see that the volume has actually tripled all the way to near 6,000 lots. This is yesterday night volume. You can see that there is a spike in volume because Russia has not agreed to renew the grain initiative, allowing the grains from Ukraine to be shipped out of the Black Sea port. And this is causing a little bit of stress in the marketplace. You can see that open interest has also picked up a little bit. So you can see, again, this is very popular for day traders as well, because you can see that most of the traded volume, half of which are not held overnight, okay? Now, this is obviously one of the all-time favorite in terms of commodity. Now, it is both a commodity as well as a financial product, because gold, for Asian, we have a natural affinity to gold. Okay, you talk to the Indian, you talk to the Chinese, you talk to anybody in Asia, we could understand the value of gold. So gold has been very attractive to trade of late. We can see that last year, a lot of central banks are buying a ton load of gold. Obviously, there is something else that's moving. We have seen how the BRICS nations are going to meet next week, okay, next month in Johannesburg. They're going to talk about a BRICS, a gold-backed currency. So you can see that gold has been in the news again. And of course, it does not help that we have a lot of geopolitical tension. And this time, a lot of people say that gold is a good hedge against inflation. But ironically, this year, we can say that while inflation is still very sticky, gold prices has not really rallied. And the gold rallied to all-time high here at $2,085 per contract at just the beginning of the, shortly after the war in Ukraine started. ever since he has been backpedaling. But I can see this market is ultimately bullish. Okay, so I'm looking to buy long term, although the prices may come off a little bit right now. So right now, if you have a view, maybe you can trade short term, but I'm not looking to trade right now because it's in no man's land. Okay, but I do want to buy, and one of the product you can buy is obviously the COMEX Micro Gold. The contract is 10 ounce per 10 troy ounce. Now this is 1/10 the size of the regular COMEX Gold contract itself, and 1 cent is equal to $1. And again, this is deliverable. Make sure that you understand that it will end up in delivery. Maintenance margin for overnight is $830, and the intraday is $35. Okay. Now, the other one you can trade is the micro silver. Micro silver is again 1/5 the size of the regular silver contract. The regular size is 5,000 troy ounces, that's only 1,000. And every 0.05 cent move is equal to $5. And again, this is also deliverable. And the margin requirement for this one is a lot higher, double that of the micro gold, $1,700, and the intraday is $70. Again, this is nowhere near where I want it to go. Unless the price spike up to $27, I will not be looking to do anything. Unless the price comes down to $20 or $21, I'm not looking to do anything now. Okay, there is a possible three-way pullback. I think the pullback scenario is right now my preferred count, and I hope the market can come down. Okay, because I want to buy. Now, one more thing. This year, silver has largely outperformed gold. So if you got a view on precious metals and you have to decide between the two of them, I will give my bet to silver, because silver has a lot more upside compared to gold for this year. For some reason, silver is bullish because we have all these talks about solar panel and medical devices. They do use silver. So silver is both a investment metal as well as an industrial metal. It has actual utility. Okay. Now, in terms of volume and open interest, gold is good. Okay. On the average, you have about almost 60,000 contract traded every single day on average, and the open interest is 30-odd thousand, which is very good as well. And you can see that the open interest is lower than the volume. It means that this one is very popular with intraday trader. Now, silver does not command the same kind of volume. It is about 10,000 contract per day, and the open interest is about 7. So you can see that again, very popular with retail investors. So these are the few products that you can actually zoom in if you got a view. Okay.